By the way, oh, we're live. Okay. So, hi, Howard. Welcome to Venture with Grace today.
Good to be here.
Awesome. Okay. So, to start off the show, I would love for the audience to get to know you a little bit more. Also, Morpheus Ventures. So, like, I know you guys are funded by the founder of Skype, and I would love to hear a little bit, like, funding story there, as well as like what you guys are focusing on.
Yeah, so maybe just quick, kind of background on me. I'm an electrical engineer by training. Although I think I've been away from engineering long enough that I probably wouldn't consider myself an engineer anymore.
Mhm.
Um, I've been doing kind of venture longer than I care to admit. I've seen probably now 3 cycles of venture capital, all the way from the dot-com bubble to the financial crisis, and this time around with the pandemic and whatnot. So I've seen the good, bad, and ugly, for good or for bad, to some extent. But certainly, I think experiences that hopefully add value to kind of my company's kind of moving forward. And so, from a Morpheus perspective, Morpheus started in 2016. That was our first fund. We're now investing out of our second fund, which is just north of $200 million. We typically do seed, Series A, Series B investments across the technology landscape, including B2B SaaS, AI, ML, Proptech, Fintech, insuretech, and whatnot. And then we also have a deep tech portfolio, which includes investments in quantum computing, robotics, space-based related like satellite propulsion and whatnot. So we really cross the gamut kind of quite a bit. I think the thing we focus on the most is scalability of kind of opportunities, and really the founder and founder makeup, instead of just product market fit. We really focus on, and certainly I focus on, kind of call it founder company market fit, if that makes sense, and how they kind of tie in. And from a Morpheus inception kind of basis, I think everybody always asks us, how do we get the Morpheus.com domain, type of thing. Believe it or not, we actually had it for a really long time in our kind of repository, and it actually kind of all the way back to kind of peer-to-peer kind of streaming kind of days, with Morpheus, Kazaa, and all that, kind of back in the days. And we happened to notice that it was still available for us to be able to get and utilize, and it happens to be the Greek God of Dreams. So it ended up kind of fitting in nicely for a venture capital fund, type of thing. So Skype obviously was one of the legacy investments that our investment team had from before. So we certainly understand the consumer tech space, and how kind of how that virality can really impact. But we kind of naturally kind of waded into enterprise software thereafter, kind of as well. So now we're fairly agnostic across the board, and whatnot. So it's fun seeing the evolution of technology, all the way back from e-commerce P2P days, semiconductor investment days, to now, when everybody's kind of focused on AI and to some extent robotics, and next generation kind of technologies.
Awesome. I wonder, by the way, I feel like one of the things that really intrigued me on like something on your profile is like your board observer of Morpheus Space. Assuming this is like you guys own like incubated project, I would love to learn more about how that works.
Ah, funnily enough, um, they're a completely unrelated entity. We
Really?
actually didn't spin them off, and I think one of the things that we probably should have done was, as part of our investment, please adjust the name so there's no confusion. But they're actually completely separate. It was actually fairly coincidental, that they happen to be Morpheus based. Maybe I should have got them to change it to like MS Industries or whatnot. But it was actually one of our first initial forays into kind of space-based related investments.
I wonder. So, like, I saw that on your portfolio, you reinvest in like robotics and like prop tech and like space and everything. I feel like I'm really fascinated by like the deep tech space. I wonder if you could share some like insights on like how you pick these space to invest in, and then typically they are very capital intensive. As a smaller check writer, I have invested in something in the robotics space. And while I was doing my research, a lot of people told me like this is a really hard space to be in because it's like hard anything hardware, it's like very hard to return venture capital money. And I wonder what is your perspective on those group of thinking, and then how did you pick these different type of portfolio to go after?
Yeah, I think on the robotics side, I think investing in the robotics space has changed quite a bit over frankly, the last 10 years, certainly the last 5. I think it used to be more of a tinkering type thing
Mhm,
where you're still trying to develop a lot of the underlying kind of infrastructure for robotics today. It used to be just picking up a mug, moving it from point A to point B was kind of a revolutionary type of thing. Now with the evolution and really the innovation of perception sensors, better compute power and whatnot, those are just table stakes, right? And I think if you're investing in robotics, I think in particular, it's not just about the technical capabilities per se. It's really about whether you can build a business, right, with the right unit economics, right? You're really looking at, can you actually make money from this, right?
mhm,
And oftentimes, I think venture capitalists really, especially ones who don't just focus on, call it the hardware side or the deeper tech side, they tend to still look at it through a lens of kind of like SaaS companies,
mhm,
right? Where you're always looking out for 60, 70, 80% gross margin businesses, right? And you're trying to kind of, put that like lens and perspective on kind of robotics companies and hardware companies, right? So it actually makes it sometimes a little harder for
mhm,
them to kind of fit that box, right? And I think to some extent, I think that narrows the number of investors that can get comfortable with looking, especially generalist investors,
mhm,
right? Or people who are looking to do those initial investments in that area. Now it's really about building that business, building the right business model moving forward. I don't think it's about being hardware, not hardware, and kind of just narrowly. I think it's really more about whether or not there are use cases and functional use cases that people are willing to buy and adopt today, right?
mhm.
Because frankly, I think the customers are starting to get more comfortable with adopting this beyond just test lines and innovation departments, right? Now it's really about potentially commercially rolling out, being on the production lines and kind of and whatnot. So I think there's a big difference in terms of how people would view kind of robotics kind of investments today than they were 5 years ago.
I wonder when you are thinking about like for example, you know, robotics aside, but for example, let's say the space industry, I guess who would be the customer? So I've heard some people like sell it to the governments, but I guess like if there is like a particular buyer group that's rising, so like people started focusing on this space, or like I guess like what does a landscape look like in terms of, let's say, the space or defense like manufacturing industry, and yeah, we can go from there. Yeah.
Yeah, look, on the space side, look, at the end of the day, I think the governments are still a probably the biggest piece of the, let's say, the commercial viability or the market viability.
Mhm.
They are the biggest customer, right?
Can you talk a little bit more about like how does the money flow in that industry?
Well, I mean, the government's pretty. There's a large. The government's not a singular entity, right?
Mhm,
There's such a variety of entities within the government that could potentially kind of play in there. Whether it's naturally the defense, the DoD Department of Defense, where it's the Air Force, Navy, and whatnot, right? And then there's also the kind of intelligence agency kind of aspect of it. And there's still kind of NOAA, for example, right? On kind of general weather management and general kind of weather visibility and whatnot.
mhm,
And so it really depends. It really spans the gamut, right? It goes from kind of public utility all the way down to defense, right? And so there's no single bucket. They all have their specific wants and needs that they're trying to kind of solve for. So to some extent, I think as you're looking at selling to governments, you got to kind of understand kind of what are you providing that's solving a problem on the other side. Similar to on the commercial side, it's no different, right? Just trying to have a product that meets a need, right? Type of thing. It just so happens that governments tend to be the largest buyer with the largest need for space-based related, whether it's Earth observation or whatnot, kind of today. Um, But the commercial side is, I think, where a lot of people are, putting a lot of hope on, right? Which is commercial space is becoming a bigger thing, whether that's Starlink, OneWeb, and a whole host of other constellations that are expected to go up over the next decade, right? And so that's still, I'd say, relatively nascent, right? You're starting to see a lot more launch capabilities, which is a fundamental and basic for getting infrastructure up into space to be able to have a space economy.
Mhm.
And we certainly made a lot of progress kind of over the past few years on that front, but we still have a ways to go.
Just using this like Morpheus space as an example, like I guess like how do you find this company from the beginning? And I guess like what's your diligence process to diligence this type of company? I know that you have a engineering background that maybe there are a lot of things that you could understand from the technical diligence, but I wonder when you're thinking about this space, how do you think like which company to pick that will like, essentially return the whole fund, or like what's your kind of thought process behind evaluate which company will be able to generate a certain level of return? And also like what was your like diligence process look like at the beginning to, evaluate this company? It would be like a meaningful company.
Yeah, I'd say, like, and maybe if I look at it more from just a broader portfolio perspective, I think we look at companies very similarly in terms of just a diligence process, right? And from how our deals are kind of typically sourced, it really ranges quite a bit. And Morpheus basically was a referral from an existing network of, let's say, seed or pre-seed kind of funds.
Mhm,
Oftentimes we get referrals from other funds with a natural next kind of stage, right?
mhm.
In terms of kind of our investment dollars and investment stage focus. So obviously that's a big part of, frankly, I think probably most VCs deal flow, especially
Right.
as you get kind of from Series A, B, and C, and kind of beyond, right? That's a lot of that work. But also we also look at it proactively, right? We reach out to companies that we find interesting, and whether that's through you know just conferences, LinkedIn, whatever the case may be, or we have a methodology where we really look at kind of all companies that get funded in the U.S. once a week between, I think it was at 500,000 and $6.5 million, right? And we kind of look through that list and see kind of which ones we're interested in connecting with and learning more about, right? So we have a combination of both, I think, referrals coming in as well as a kind of proactive reach outs. And we also have different theses that we're interested in, kind of that we refresh over every 3 to 6 months. And so we proactively go out and map the space and reach out to those companies that we think is interesting and that could be viable kind of for us. And look, in terms of evaluation process, you're absolutely right. I think one of the things that we look for is whether or not a company can be impactful from a return perspective for our fund, right? And so there's sometimes you love a company who's got a great
Mhm.
business. The challenge is, maybe it caps out at $100 million, $200 million equity valuation, right? That's harder for a
Mhm.
fund of our size to do. So oftentimes we're really looking, to your point, a fund returner, right? And how does that kind of map out in terms of what type of outcomes is required, right? Oftentimes, at a bare minimum, it's almost like $500 million and and up. And I think we're generally trying to gun for billion, 2 billion plus potential outcomes to be able to kind of really move the needle for our fund.
I wonder, as for the in terms of like fund construction perspective, like returning a $200 million fund is like very different than like returning like a $10 million fund. You have to have certain amount of like ownership throughout the company's like transforming journey basically. And I wonder, how do you like think about fund construction? Like, um, yeah, like how much would you? I wouldn't say like how much, but like yeah, just like the thinking framework behind like the follow on versus like the initial track. Since you guys also invest in between seed to Series B, I
Yeah.
wonder like what's a thought process there.
Yeah, I think the way we think about it is that, with the lens that it has the potential to impact the fund, right? And I think the way I look at it is, what do I mean by impacting the fund? Is, for a 200 million fund like ours, can I return half the fund at a minimum, right? At least the potential to have the fun. Obviously, there's there's a lot of
Mhm.
trials and tribulations along the way. Some don't always make it, but do they have their ability to return? In this case, let's say $100 million, and you sort of work a bit backwards from there, right? And so a lot of times, what you're trying to evaluate is not just your entry point, but really your exit point, right? I think
Mhm.
and that's hard to do sometimes, right? Because you're prognosticating potentially 3, 5, 7, 10 years out sometimes, right?
Mhm.
I think you make the best judgments you can, and I think that's why I think a lot of VCs, including ourselves, really look at the market opportunity, right? I think much more so because that gives you a lot more room to work with, right? Now, in actually greenfield opportunities, there's not a number you can notionally kind of put in place right now, but I think it's kind of how you think about the market evolving, and that's kind of your lens, your gut that you've built over time, your expertise that you've kind of been able to kind of garner, right? And hope that you're looking at it in the right way, for example, right? And so that's really, I think, the biggest part of our lens is really looking at kind of, is there a sizable enough market so that they can, if they actually execute, right, can they actually kind of get to the outcomes that we're looking for?
Mm. I wonder, as for some of the market that you are looking at, I feel like one of the challenge is like, how do you kind of evaluate the TAM? Because let's say using like a robotic example, let's say if you created um a robotic coffee machine or something.
Right.
So, like, I've seen, like, the robotic coffee arm somewhere in San Francisco all the time. I'm keep thinking, doing the math of, like, how many people would actually use this machine, and, like, what is a total addressable market? If you're thinking about the coffee market, that's yeah, like, everybody drink a cup of coffee every morning, probably not everybody, but, like, let's say, I don't know, half of America drinking, like, a cup of coffee every morning, a cup of like, maybe half of these people are drinking a cup of coffee in the afternoon. But how many people would actually use a robotic arm? So I wonder, like, what's your thought process to do due diligence on these, like, um, robotic companies, or like any type of, like, I guess specifically hardware companies, because I saw some of your portfolio. Of course, you do software, but like, um, just curious, like, how would you kind of address, like, think about like the market sizing, and then as for like, pushing it forward to like think about like if your portfolio company can capture X or Y, what does the diligence process look like for you?
Yeah, look, I think it's easy to sometimes just look at from a top down approach, right?
Yeah.
But I think, especially, I think more for kind of hardware companies, right? I actually do think
Mhm.
you want to look at it from a bottoms up perspective, right?
Yeah.
And just understanding kind of what the market opportunity is. Obviously, I think as capabilities grow and functional kind of functionality gets increased, and whatnot, and specifically, I think for robotics, I think the biggest kind of like factor in there is just a labor shortage aspect of it, right? And so
Mhm.
as you're trying to transition kind of to that, and potential reindustrialization of the U.S. In terms of manufacturing capability or nearshoring and whatnot, that all has an impact, and so that kind of builds into kind of how you think kind of robotics could be impactful in terms of a unit volume perspective moving forward, as well as kind of how much of that work are they going to be able to kind of do, right? And so we really look at it from a ground up perspective, right? And we look at the number of factories and whatnot, what production volume, right? And then
Mhm.
that's required or needed, and you're sort of kind of building up kind of to it,
Mhm.
right? And if you go from a blank sheet perspective, you build up into kind of that equation, but you're also looking at what the total demand is, right? And so
Mhm.
if you look at kind of the total consumption demand for whatever the robotics is doing,
Mhm.
right? So I think it's hard as just I think looking at robotics as a singular, I think thing, I think is difficult, right? There are
Mhm.
guys who just supply the robotic arms, for example, whether it's Fanuc or Universal Robotics or whatever the case may be. That's a slightly different thing than if you're trying to actually build a functional robotic cell, for example, that is producing X widget, right? And whatnot, right? And so if you're looking from just a robotic arm perspective, maybe the addressable market is much more wide, right? But if you're, for example, picking strawberries, right?
Mhm.
Kind of agricultural robotics,
Mhm.
right? then you have to really more focused on, okay, well, what does that mean for that specialty crop, for example, right? How much production does it do they actually do, right? What the harvest cycles are. So it really depends on the situation as you get more narrow, and whether or not kind of your solution is more broad or vertical specific, right? At
Mm.
the end of the day. So I think a lot of people tend to look at robotics as just kind of one amorphous kind of blob or kind of vertical kind of per se. But I would say that you really have to kind of break it down into, are they more vertical or horizontal in terms of the market that they're trying to address.
I wonder, as for like, since you mentioned that, like, you guys work with some like even earlier stage investors, like the seed investors, or like maybe even earlier stage. When it comes to earlier stage investing, I feel like a big challenge is like, um, unless they're like second time founder, it's like hard to having like a benchmark on if the person can execute off what they're saying. And I wonder, um, in that sense, like there's like a lot less data to work with. Let's say if they're just using the strawberry picking example, let's say if they have no, like, for example, let's say if you're a PhD student coming out of UCLA and you come to Harvard, be like, hey, we are creating this like robotic strawberry harvest robotic arm or something. And then if they have no industry experience as working on a farm, or like having distribution to every single farm in America, or like I don't know how the strawberry picking thing would work, so to like make it happen. Maybe they are developing the specific tag for it. For example, it can detect like the strawberry hiding behind the tree or something. So I guess not the tree, but I guess strawberries on the floor. But so I wonder, for example, they have a tag expertise, and you're trying to diligence if they could do the expansion or like do the distribution part. I guess how would you kind of evaluate it, although like maybe the number makes sense. Let's say if they just occupy, I don't know, from like a bottom up perspective, let's say if the robotic arms are going to cost x dollar, maybe the profit margin is shorter because of it's like, let's say different farm will purchase this product. I guess like how would you kind of like, what would be your benchmark to, or I guess like what would be your diligence process to diligence something like this?
Well, for good or for bad, something that that's where potentially being Series A investors a little bit helps solve that
Better.
equation a little bit. And so, like, oftentimes, fortunately for me, my compatriot at the C level, I think sometimes they have a lot of that kind of figuring out to do, especially if it's like literally a PowerPoint deck, right? And a
Yeah.
founder who's just trying to start. Look, typically, when we get involved on a Series A kind of basis, more often than not, they have an MVP, right? And maybe they
Mhm.
have something out in field already, right? And some of the better ones actually have revenue, right,
Mhm.
starting to come in, right? Robotics, like I said before, robotics today is very different from robotics 5 years ago, right?
Mhm.
At the Series A level, people can have actual kind of customers and revenue, right?
Mhm.
In the past, you might not get that until Series B,
Mhm.
type of thing. Um, but I think absolutely having people who have done it before, whether they're second, third, or fourth time founders, to some extent, I think they better understand the trials and tribulations, right? But not necessarily, it's exclusive to them, and whether they learned it or not, that's a different story, right? Type of thing. So it, it really depends on the individual. It certainly, I think, probably takes a little bit more, hopefully, guidance, right, and providing some additional perspective to maybe first-time entrepreneurs and first-time founders. Um, but sometimes, a lot of really good ones, have done their homework, right? They've sometimes done more homework than people who've done it before, type of thing, relying on just simply their experience, right? And it's real. I think it really depends on the individual, right? And whether or not it's the frame of mind, right? More so than just simply having experienced it or not, right? Like I said before, being a second and third time founder doesn't mean you're any better potentially than a first time founder, right? It's just that, you hopefully have garnered some experiences that maybe you don't make, the same mistake again that you made the first time around or the second time around, type of thing. So for us, I think we certainly, I think, are looking to back entrepreneurs and back founders. And as I mentioned before, kind of that founder company market fit, right? Like, why them? Why now? Right? And how are they thinking about impacting? How are they thinking differently, kind of about that market space that other people haven't, thought about, right? I think that's, for us, that's a little bit more, kind of important, right? Obviously, their technical capability, especially if you're building hardware, is a very big piece of it, right? If you can't if you can't make something work, it just, there is no there, type of thing. But oftentimes what we find is that, I think technical founders end up really partnering up with people who, a bit better understand the business side, right? Especially on the robotics side, it's not just about building the robot, right? It's about how to, can I build a business, right? And so if they don't inherently have, the market intelligence, right, or the understanding of the markets of what the customers want, right, like that can be an issue, right? And I think fairly early on. So I think oftentimes, we find a lot of entrepreneurs are partnered up with this one side. What one part of the team is very technically savvy, and the other part of the team is much more market savvy, type of thing. And it's a pretty good combination to have, especially if you can have it at an earlier stage.
I wonder when you are like diligencing their revenue on, like, for example, on a certain, so like I know that you mentioned like Series A, you will have some data, for example, they would have customer and stuff. I wonder what would be a good benchmark for the company to for you to evaluate if this is like a good either valuation, or like if they would be able to, for me personally, I would look at like how put like will this company be potentially raising the next run, and like all that kind of things. And I wonder what would be your lens to look at them, and then what would be realistic in terms of like evaluate a company's like valuation if it makes sense. Because I feel like as early stage as it gets, like a lot of the valuation are kind of like um made up, and I wonder like how would you evaluate if something is like irrational?
Look, I think, obviously, I think in the current market, right, valuation can be quite varied. Let's
Yeah.
just say, right, you can have some fairly outlier type valuations, and then you have much more, kind of straight down the fairway, kind of
Mhm,
more market valuations for probably 70% of most companies that get funded,
mhm,
right? There's always outliers, so you always, kind of have that in mind, but call it, forgetting the 7%, probably 90% of, kind of everybody else is pretty much more kind of more down the market fairway,
mhm,
type of thing. Look, from an A perspective, we have conversations with, Series B and C kind of, investors all the time, right? And kind of what types of deals are they doing? What are they thinking? How are they thinking about valuations? And frankly, like at the B and C, kind of stage, they get to be much more pragmatic, right? They look at the KPIs, right?
mhm,
There's revenue, right?
mhm,
There is. It's not just storytelling anymore, right? They have to have kind of the proof in the proof is in the pudding, type of thing. So they'll say, look, for that growth rate, for that unit economics, like gross margin, and that type of absolute dollar value in terms of traction on a top line basis, we're paying X, right?
mhm,
X multiple, right? And we sort of take that as a data point and assess, like, hey, look, if this company needs to raise another round of financing, and most companies kind of do these days, right?
mhm,
If you raise a Series A, more likely than not, they're going to need a Series B financing, right? Some people are
mhm,
very efficient. Hopefully they are. And, Series A to exit, awesome.
mhm,
Love it, right? But a lot of companies still need that subsequent round of financing to be able to sort of get there, right? Type of thing. And so I think what's hard to solve for is multiple compression, right?
mhm,
If I pay 20x multiple and the next round is 10x multiple, right? That's hard, right? The company literally could double its revenue and still
mhm,
be treading water, right? Type of thing. So I think we have that as a lens and as a data point, right? As to kind of what we think is doable today based upon kind of where we think the company can kind of grow to in the next 12 to 18 to 24 months, right? As they are then in position to raise that next round of financing, right? So you're definitely taking that lens so you understand that, look, what can I actually pay for this today, right? That I can still have at least hopefully a markup, right? But we're not like, no, I don't think anybody's in this business trying to stay a flat round kind of per se, right? You're trying to get a meaningful markup from round to round, right? Type of thing. And so you kind of look at it with that lens. I would say it is absolutely more challenging, frankly, at the seed and kind of even at the A level these days, right? Because you're that inflection point potentially at that product market fit inflection point sometimes, right? If you're sometimes just at that $1 or $2 million kind of mark, for example, and the Series B guys wants 5 million plus, right? And possibly 10 million plus, right? In terms of revenue. All right, so like, how reasonable is it for you to be able to get from where you are now to where you are suitable for a typical Series B investor, and what valuation would they put on for a company like yours, right? And so it's never just one single metric, right? I think you're considering like a company who's growing 50% is very different from a company who's growing 300%, right? A company who has 70% gross margin is getting very widely different valuations than a company who's doing 20% gross margin, right? Type of thing. So all of that comes into that, call it venture math to some extent, type of thing. It may look a bit nebulous and amorphous, but to some extent, there's a method to that madness.
I wonder, I really like what you said about like, building relationship with the next round of investor, and then kind of like look at it from like their lens on, how much multiple you have to achieve, and then, what's their benchmark that they're using and all that. And I wonder, when it comes to investing in like robotics, or like investing in hardware in general, I I feel like one thing is like the sales cycle could be very long, right? Like let's say if I also saw that you invest in like healthcare related companies, and then like real estate. I feel like these are industry that, like, assuming the sales cycle could be like, taking forever. Also, like especially the space industry, like if you're developing a rocket, like that's huge. So I think that I'm not familiar with the selling cycle to, like, I don't know, the government of, here's like a rocket that we discover, like we like, created, and like I don't know what's that sales process look like. Um can you like maybe give us an overview of like how these companies are actually, let's say the companies that are selling something to the hospital, or the company that are selling something to the property tech, a property tech company selling it to the real estate companies, or like, the spaces company that's selling it to the government? Like, how long would the sales cycle be, and then how do you kind of develop the relationship within people in the industry to kind of examine, will the buyer buy this thing?
Yeah, look, sales cycle is definitely something that I think everybody focuses on kind of quite a bit, right? Especially if you have runway that's 18 to 24 months, and sales cycles are 18 to 24 months. That can be problematic, just from a duration matching perspective, right? To be able to kind of get to the benchmarks that you need, right, before you run out of money. So it's something that we focus on kind of quite a bit. And you're right, absolutely right. Healthcare is notoriously kind of has a long sales cycle, right? I think manufacturing industrials tends to have a long sales cycle kind of historically, and aerospace and defense tends to have a long sales cycle, kind of potentially, especially if you're selling to traditional kind of companies like primes and whatnot. And the U.S. government, government sales can be lengthy, right? But obviously the carrot at the end of the rainbow can also be very large. But how do you? But it's tough, right? Because as you're traversing, time, right, and there's a sense of urgency that you need to kind of, kind of still make it happen, right? And for us, I think, we're fortunate to have, kind of be able to leverage our relationships within kind of the commercial networks, our relationship within kind of governments and whatnot, understanding kind of what their processes look like for this type of product, right? It's very product specific, specific. And then we also are leveraging kind of our LPs who have really strong relationship with certain sectors, right? And asking them to provide feedback on the company as a customer from a customer standpoint, right? And that, look, the old adage of like, you want to invest in something that is a need, not a nice to have, but a need to have, right? I think that adage still holds true, right? I think anytime you're on the nicer to have spectrum, the sales cycle eminently ends up being longer, right, than an acute need, right? And so we really we try to focus on things that are a pain point today, right? As much as you can, I think in a lot of these type of situations, like why are they wanting to buy this in the near term? Today, the next quarter, the next 2 quarters, right? Versus is there is there not enough impetus so that they can wait, right? Usually people try to kick the can down the road by spending money. They just do, right? I think most companies, are less proactive, more reactive, right? It's just human nature, right? Because they have fires that they're trying to put out today, something that doesn't need to be addressed until tomorrow. Sometimes they'll wait till tomorrow, right? And so what we're trying to focus on is that problem set, right? Do you have the product market fit? I think Addis is actually very apropos here, right? Is there product market fit today, right? Or is there a product market fit near term, right? And that's something that we're trying to solve for all the time. And sometimes you get it right. You do the best you can to get it right. But there are still many times you get it wrong, right? Whether it's the market shifting in a different direction, right? Or different circumstances just impacting the market, type of thing. So I think you do the best you can in having those customer calls, trying to at least talk to those people who are potential customers kind of the companies and see what that feedback looks like, right? And use that as a data point to evaluate whether or not it makes to invest today, or maybe it's a bit further down the line. It's a better opportunity.
I wonder if let's say if you're like a person who is like a younger associate somewhere, like how, or like an emerging manager, how would you build the relationship with people like your LP who are maybe like at a certain like big institution, or like let's say for example, I feel like selling to the government itself, it's like it's like a really high chasm you have to like cross kind of like you have to actually have that like access to the people who would be the buyer. And I wonder, like, for a younger person, how would they build the relationship with like um maybe let's say call it a Sutter Health or something that's like a big institution. If they have something that, like, if they have like a SaaS product they want to sell to the hospital or to sell somewhere, how would you kind of like initiate these kind of relationship if you're like a younger person?
Yeah, look, I think as a younger professional in the VC world, right, and as you're trying to kind of build the relationships that you can hopefully, and look, I'm a believer in a mutually beneficial relationship, right? It's got to be something that you're providing value to them as much as they're providing value to you, right? It's very much a two-way street, right? And I think those are win-win relationships are the ones that, frankly, I think last the longest, right? And so you're always trying to find kind of what you can provide value to them, right? I think you start from that lens, right? Of how can I be helpful to them, right? And I think with that lens, I think as you approach a relationship, building the relationship, right? Look, a lot of times, a lot of these institutions are also trying to build relationships on the other side, right? They want to kind of see what's the newest and greatest, right? They want to also be in the know, right? And so, and they're reaching out, right? They're out at conferences, events, and whatnot. They're also trying to be that outward facing. There's a counterpart to you on the other side, right? Your job is to be able to kind of meet that counterpart, kind of to at where they are, right? And it's really the legwork that you're doing, right? And once you actually make that connection, that first connection, then like I said, I think it's about how do you kind of provide value to each other, right? To build that
Mhm.
long-standing relationship. I think that's important, right? If it's always a one-way relationship, right? And where one party is always asking of the other, I'm not sure that's gonna work long term, right?
Mhm.
And you're not. I don't think you can build that relationship where you're texting a guy, "Hey, I just love to get 2 seconds of
Let's
your
get
thought,"
coffee. Yeah.
right? Good, bad, or ugly, right? And I think, I think in our business, I think you always have to look at the long-term relationship, right? That you're building. I always hearken kind of venture capital is like farming, right? Yeah, you're sowing seeds, right? The big difference is you don't know when you're harvesting, right?
Mm.
Right. But you want to sow as many seeds as possible, right? And you're nurturing them, you're watering them, you're providing sustenance, you're giving, right? Sometimes
Mhm.
early on before you're really kind of harvesting and reaping the rewards, right? And that's with almost anything that we do, right? Whether that is building relationship with founders, building relationship with LPs, building relationship with strategic partners and whatnot. A lot of this is just nurturing that relationship, right? I think that's the biggest thing I would tell, like, kind of people who are newer to the industry is like, just how do you nurture that relationship moving forward, one at a time. This is not about like, you know, trying to connect with 100 people at one conference and taking a name card, right? And that's it, right?
Mm.
It's really building that one or two or three really good relationship from that one thing and build on that over time. And over a number of years, that starts adding up.
Mm. I wonder, since you're I guess, like, there's, like, 2 questions there. One of them is, you mentioned there's, like, a counterpart to, like, the younger people out there, like, for example, let's say, like, a big network of people that are in, I don't know, the government's defense tech department sitting there trying to meet the young people. I guess, like, how do you kind of find them? You mentioned about, like, conferences or something, like, I guess, like, what would be, like, the type of people that you should go after that, like, for example, if I'm just, like, waiting to speak at, like, I don't know, speak with, like, the CEO of, like, a Fortune 100 or something, it's probably hard to constantly getting their attention. What would be the right department of people, or, like, maybe the title of the people that, like, younger people would have a better chance of success to approach?
Well, I think, by the way, sometimes it's not just about the executive level, right?
Mhm.
And similar to venture firms, it's not all about sometimes having to talk with the GP,
Yeah.
right? Like it's a lot of times the people who are out and about can be just as impactful, right?
Mm,
They know how the dynamics work internally, right? They
mm,
can actually help you maneuver, right? Much more so and have the time to be able to help
mhm,
you maneuver, right? And so it's not just about like hitting a specific title or not, right? A
mhm.
lot of times it's nurturing a relationship. I still remember when I first started in venture capital, like, we were I was it was a young whippersnapper kind of that's trying to kind of start building relationships, right? I've been doing venture capital now longer than I care to admit. It's been almost 2 decades, right? So, but now, for example, all of the younger people that I met, right? A lot of our partners, GPs at other venture firms, are now managing directors at so and so company, right? And so it's not just about. That's why I say it's a long game, right? It's
Mm,
not just about like what you can reach today. It's
mhm,
building that base and foundation for you moving forward, right?
mm,
And so I think people are too focused on just the near term
mhm,
potential rewards, even though that I think that's a bit sometimes um, a fallacy to some degree, right? Just build a relationship with the person, right?
mm,
And that will grow over time. And if you want an in at X company, Y company, anybody that you can build a good relationship with there is an entry point. It's a
mm,
foot in the door,
mm,
right? Let that be kind of that first step, right, to building further relationships in that firm. Whether they are the ones who actually maybe become that person for you, a year, 3 years, 5 years, 10 years down the line, or frankly, they can help you navigate to get the right person, right? And with an internal referral, believe it or not, it's actually much more effective than if you just do a cold call, right? You do a handshake with a guy at a conference and that's it, right? Type of thing. So I think there is multiple paths to an outcome that you're trying to solve for, but sometimes shortcutting doesn't always work. Sometimes I think you do have to play the long game.
I wonder, as for if you're a founder, like today, instead of like building a relationship down the line kind of thing. So for example, if you're a founder trying to sell it to a big corporation, how do you organically build these kind of relationships? Because technically today you are trying to sell your I don't know, delivery drones to DoorDash, and you know no one at DoorDash. Maybe you know like a guy who delivered you food at DoorDash, but like I guess how do you kind of like create the relationship to the corporate to kind of like get to the certain level of like decision maker to pass through this maybe partnership or something?
Look, it's hard, right? And I think that's why I think you have founders who have done it before, who's been in industry, who goes into these startups with prior existing relationships and networks, right? That helps a lot, right? Founder-led sales is a thing, right? Especially like kind of from going from 0 to 1, right? Type of thing. And so why that's why I think there's a big reason why, like, you see people back and repeat founders, or founders who come from I think fairly prolific backgrounds with inherent networks built in because of what you just said. Let's say they have a relationship with half the Fortune 500s, right? Or they know everybody in that industry, right? And so their Rolodex that they're starting off with is pretty strong, right? And so they can make that call going in. And that's kind of where I think maybe first-time founders, or people who are building from an academic and now a technical and business side of things, right, that they're more challenged with. They have to go figure out how to break into that market, right, type of thing. And that's where, frankly, they're probably going to need to have some help, right? They're probably going to have to bring in some help there, right? It is very hard, right? How do you get into so-and-so company when nobody knows you, right? Nobody knows if this is good, bad, or ugly. Nobody knows if this works. Nobody knows who you are, and are you trustworthy, right? Can you do what you say you can do? So I think it does make it much more challenging. I think when you come in basically as a fresh face, right? Type of thing. And oftentimes you do need to probably bring in some help kind of with that, to be able to help massage or soften up kind of those relationships a bit, right? But it is hard. Like, I'd say that bring the help is probably one way to solve that problem, right? Whether that's a co-founder, whether that is your CRO, your VP of sales, or whatever the case may be, right? That has a relationships that that you can kind of lean on early. But it is much more challenging. There's no one great way. If there was, I'm sure that person would be making gobs of money just consulting for every startup in the universe here, right? Type of thing.
I wonder, when it comes to like working on your current like portfolio companies, why don't we start with like, can you walk us through like any of your portfolio company, from how you fund them to how you diligence it to how you like win the deal to eventually your thoughts on liquidating the company from like in the future?
Yeah, look, I'll take one. Like, since you're asking about the full gamut, I'll take one of our companies that we exited about 18 months, 24 months ago now, and a company called Bridg, right, which we sold. I think it was in 2021, I think
Yeah.
now, when we actually exited the company.
Mhm.
I met Ahmed through actually a mutual friend who was at another fund. Said, "Look, you should meet the guy. He's doing something awesome." And we literally, first meeting was at a coffee house in Sawtell, which is in Westwood, near UCLA. And that, for that first meeting, it was really about building relationships to see kind of if there's a mutual fit, right, with each other in terms of our fund, and the founder in the company, right?
Mhm.
And I think it was we hit it off in terms of like we shared the same potential vision and kind of where we want to take the company and whatnot. And we were fortunate enough to be able to kind of win that deal because I think we thought it was a mutual fit. A lot of times when you like the reason why you win a deal per se may not just be a pure numbers thing, because let's say like if all numbers are equal, for example, like who do you pick, right? Type of thing. A lot of it is just that mutual comfort, that mutual relationship that you've built, right,
Mhm.
during that process that may end up swinging one way or the other, right?
Mhm.
And look, life's too short, right? Kind of working with people like you don't really like to work with is probably hard, and
Mhm.
probably tend not to be the best outcomes, right?
Mhm.
I think having people who you can work with, not just because you always agree, but you have there's a mutual respect in terms of kind of what you bring for each of you bring to the table and how you can position the company for success, and you can actually move the needle. That's important, right? And so there was a lot of that. There was I think just a mutually good feeling on fit, kind of between kind of us and them. And so that kind of how we got into that deal, right? And look, there's never a straight line from investment to exit, right? I think the company, I give Ahmed, the CEO, a lot of credit. He pushed through, sometimes hard, the hard times, right, to get to an outcome. And frankly, I think it, it was through just pure perseverance and tenacity,
Mhm.
on his front, and kind of getting to the outcome that we did. And I think all in, I think it was going to be closer to like $400 or $500 million in cash that
Mhm.
was kind of paid for the company at the end of the day. And that was a great outcome for everyone, right?
Mhm.
I think, but there was no straight line. I'll tell you what, like, for a while there, you were trying to see if there's a there, right? And that frankly probably happens more often than not for startups, right? It's never a straight line, like up and to the right all the time, right? Sometimes you need to hit that inflection point, and sometimes a hockey stick just starts hitting,
Mhm.
right?
Mhm.
Um, and so we exited at a good time. Everybody, I think, it was a good outcome for everybody. And I think, you learn a lot, right? You have to be a little lucky also in timing. They exited at a good time and kind of in the market, right? And so you do need a little bit of luck, but I think a lot of the perseverance and tenacity by the founders is a big piece of kind of traversing that journey.
I wonder in terms of like exiting, like I feel like exiting itself, it's kind of like an art. And I wonder when you are thinking about like for liquidating certain type of like portfolio companies and then some companies maybe keep on raising and like I wonder when do you know it's a good time for your firm to exit a certain company. It's either like they are sold to another company or you are liquidating your rounds of um, funding for a particular company. I guess like how would you make the decision
Look, look,
exiting?
I have a fundamental belief that you should sell when your founders want to sell,
Mm,
right? Um, because that's an important data point, right? Um, when your founders want to sell, you should at least listen, and why, right? Um, I've learned that through the years, and there's good rationale kind of for at least listening intently to the reasons. And I think the old adage of companies are bought, not sold, I think really
mhm,
rings true, right? I think generally the better outcomes, right? The outcomes that we all like to write about, the $1 billion outcomes, the $5 billion outcomes,
mhm,
whatnot, aren't companies that we're looking to sell notionally, right? Is usually it's somebody coming in and says, I want to buy you, right? And then you run a process, right? They may not be the guy who ended up buying, but they're the instigator of
mhm,
potentially a process, right? Of saying, oh, well, somebody's valuing us very well, very
mhm,
healthily, right? Maybe we should think about right? If this is a path that we should, go down, right?
Mm.
And then you start running that process of seeing maybe is there others, are there other companies that may be also interested to make sure that you maximize the value for what you've built, right? Type of thing.
Mm.
So I tend to think in those two kind of data points, if that makes sense.
Yeah. I wonder, from like a investor perspective, since like we chat a little bit about like portfolio construction at the beginning, like I wonder how do you make the decision on like if um you should liquidate your portion of the company
Sure.
versus the company itself decided to sell or like, something.
Look, there are situations where, let's say it's a secondary sale,
Yeah.
right? I
Yeah.
think when you're getting acquired, it's all or nothing type
Yeah. Yeah.
situation,
Yeah.
right? It's just I don't think there's a choice per se. For
Yeah.
like,
Yeah, yeah, for sure.
on an IPO basis, look, we're private investors. We're not paid to hold public stock, right? I think you try to liquidate as expeditiously and as efficiently as possible, right? Type of thing. So that's kind of my own thought kind of process kind of on it. I think on a secondary thing, I think that's a bit more of you're like circumstance dependent. To your point, right? You know, I invested at Series A. I'm probably not exiting at the Series B, right? That almost never makes sense, right? The
Mhm.
type of exit that you're looking for, the multiples on your investment is usually not the jump between a Series A round and a Series B round, right? But if the company, for example, raises, you know, a much later round of financing, right, and you've been in it for quite some time, and the returns are 20, 30, 40, 50x already, right? Of what you kind of already of when your first investments based on your first initial investments. I think you start thinking about, does it make sense to take a few chips off the table, right? And you may not need to sell your entire position, but whether or not you actually want to take a few chips off the table to provide some liquidity to your LPs, kind of a
Mhm.
whatnot. I think it's that part I think is a bit more art, right? And
Mhm.
circumstance dependent, right? And because, you know, what are your thinking of the horizon for the bigger exit, right? Whether that's through an
Mhm.
IPO, or do you think an M&A is, 12 months down the line, or is it 3 years more down the line? I think that all kind of plays into the to sort of the math, right? Of kind of and consideration of whether you should, take a few chips off the table today, right? Versus holding the entire way through.
Mm. I wonder if there's any particular benchmark that you would use to make the judgment call. Like, I know this is like a more case by case scenario, but like I guess like since you are in the industry, like for like a long time, and then like I'm sure you've seen certain cases that are very interesting than, I guess like people who are more on the entry level of the ecosystem.
Look, there's a saying that, pigs get fat, hogs get slaughtered, right? Type of thing, right? And I think, yeah, I literally just had this conversation with another VC. He's like, look, he's never regretted ever taking money off the table. Ever, right? Like throughout his career, he's never regretted. He's done it. He's done it a number of times. He never regretted it, right? Type of thing. Because to some extent, a bird in hand is a bird in hand, right? Type of thing. There's certainly, I think, enough instances where companies have gone through sky high valuations, right?
Mhm,
And before an ultimate exit happens, they weren't necessarily a high sky high valuations anymore,
mhm,
right? And we've all seen that, right? Like that's not exactly an outlier. That happens, frankly, more often than people think, right? Type of thing.
mhm,
Um, and so as you write up, right? Look, if put it this way, if a seed stage guy, for example, if you invested at a $5 million valuation for a company because you tossed in $250,000, right?
Mhm.
If the company's at $1 billion, right, you're talking about 200x, right? At that point in time, obviously there's some dilution in between them, so maybe it's not exactly 200x, but there is nothing wrong with taking some money off the table at that point in time, like in my opinion,
Mhm.
right? And people have done so, right? And similarly, if you just kind of do the similar scaling, right? If you're like, look, if your entry point was at $50 million, at $10 billion may not be the worst thing in the world to take a few chips off the table, and possibly even before that, right? Type of thing. So I do think it's very circumstance dependent, because I'd say this because if you truly believe that the exit, and frankly, it's also the time, the where you are in the span of your fund. For example, let's say most funds are 10-year funds, although some funds that got raised recently with a little bit shorter time period. But traditionally, funds are 10-year lives, right? If you are fortunate enough to have an exit, not exactly, if you're fortunate enough to have massive markups for a company that you were just 3 years in, 2 years in, maybe you think there's a lot more to ride. Maybe you or great, my IRR is great if I cash early, right? It's because it's time dependent, right? So you're judging it, but you could also make the argument that, look, we think there's a huge amount of upside. We want to kind of be able to wait a little bit more. Or let's say the markup is now in your 9th year, right? You finally got the J curve really started to hit, right? You've held on, J curve starting to hit. You're a year away from your 10-year life. Maybe you have another plus 1 year kind of extension after that. But that's probably a good time to start harvesting, right? Like maybe not even start harvesting, hopefully fully harvesting for your LPs, right? Or more meaningfully harvesting for your LPs at that point in time. That's a different circumstance, and given that, I think you're probably more predisposed to actually, ringing the bell, kind of on getting some liquidity, right? Because you are further down your fund life. That's why I say it's not always a cut and dry type equation. But like I said, I have friends in venture who will absolutely take money off the table kind of whenever it's possible. Sometimes it's not always possible to sell secondary, right? Depending on how the round is done, right? So it's very opportunistic, I think, from that standpoint, type of thing.
On that note, thank you so much, Howard, for coming on the show today. I know that you probably have a next call already, and thank you again.
No problem. Great to be here. Thanks for having me, Grace.
Let me quickly end stream.